Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. The subject of our report is the JPM collar strategy, an in-depth structural analysis and its market liquidity implications based on the data of March 28, 2026.
This video presents a direct informational narration of the source document.
And just a quick notice before we proceed. This content is for informational and research purposes only. As you know, investing involves significant risk, and past performance is never a guarantee of future results. Here's what we'll be covering. First, we'll establish the market context for this type of hedging. Then we'll get into the background of the strategy itself and who has access to it. From there, we'll dissect the three-leg collar structure and, critically, its mechanism for impacting the broader market. We'll show you how to track the key expiry levels in public data, and we'll conclude with the practical applications and a summary of the risks. So, in a market that's essentially going sideways, understanding institutional hedging isn't just helpful, it's everything. The JPM collar is so massive and rolls over so predictably that it has, in effect, become a key liquidity anchor for the S&P 500. This is why observing these institutional flows can often be a far more precise exercise than standard technical analysis. Okay, so let's dig into the background of this strategy and the specifics of who can actually participate. The strategy is primarily executed through three flagship funds, JHEQX, JHQDX, and JHQTX. Now, the key thing to understand here is that these aren't ETFs you can just buy and sell on an exchange. They are closed-end subscription funds, and that structure is fundamental to the stability of the capital they manage. And access is highly restrictive. To invest, you must be a qualified investor, meeting at least one of three pretty strict criteria. You need an income over $200,000 for the last 2 years, a net worth of over $1 million, not including your home, or you need to hold a recognized financial industry license. We're talking about a very large pool of capital here, somewhere in the range of $28 to $30 billion. And since that capital is so stable, the fund's hedging activities happen like clockwork. That predictability, well, that's the whole point. It creates these massive observable transactions at fixed times and around fixed levels that anyone, including non-institutional players, can see. All right, let's break down the actual mechanics of the collar itself. This is really the engine room of the whole strategy. At its core, the strategy is about creating a protective band around a core equity portfolio of about 150 to 155 large-cap stocks. Here's how the hedge is built. Leg 1, they buy put options about 5% out of the money. This is their primary downside protection, but that costs money. So leg 2, they sell puts further out of the money, somewhere in the 15 to 20% range. This generates income to offset the cost of the first leg. And for leg 3, to bring the net cost of the whole structure as close to zero as possible, they sell out of the money call options. Now, this structure creates very clear risk boundaries. The hedge is only effective for market declines between 5 and 20%. Anything less than a 5% drop isn't covered. And, importantly, any drop greater than 20% is also not fully covered. On the other side of the trade, that short call means they give up any potential gains above that call's strike price. It's a classic trade-off. You cap your upside to pay for a specific band of downside protection. So a $30 billion fund puts on this massive, predictable options position every quarter. How does that actually reshape the behavior of the market itself? Let's get into the impact mechanism. It really comes down to how market makers have to react. First, there's delta hedging. To stay neutral against JPM's flow, dealers are constantly buying and selling futures and stocks. Second, and this one's powerful, is the gamma effect. As the S&P 500 approaches one of these big strike prices, the gamma exposure explodes, forcing dealers to hedge more and more aggressively. This creates a pinning effect that can literally hold the market in place. And third, you see the order book get incredibly deep around these strikes, which acts as a huge brake, soaking up volatility. But here's the warning. Right around the quarterly expiration date, all of that gamma that was holding the market stable just disappears. When that stabilizing force is suddenly removed, it can release a lot of pent-up energy and significantly amplify short-term volatility. Okay, so let's move from the theoretical to the practical. How can we actually see this footprint in the market using publicly available data? Well, the good news is it's remarkably straightforward. You just need to look at the open interest for the quarterly S&P 500 options. For the March 31st, 2026 expiry, you can see it plain as day. 37,600 contracts of open interest sitting at the 64.75 put strike. This is the fund's long put, and it functions as the major support level for the quarter.
And if you look further down, you find the second leg. At the 54.70 strike, you see another massive position, 34,500 contracts. That's their short put, defining the bottom of that hedge band. And finally, looking higher, at the 71.55 strike, there's the third piece of the puzzle, 34,700 contracts for the short call. This is what creates that effective resistance ceiling for the market throughout the quarter. So, how do we apply this knowledge? The key is to stop thinking about these levels as absolute brick walls and start thinking of them as probabilistic weights, as areas where market behavior is likely to change dramatically.
Let's consider two key scenarios. If the market makes a decisive break below that big 64.75 long put level, you get what you could call a break failure. The gamma pinning effect is gone, dealers pull their hedging bids, and the order book thins out, which can lead to a very fast cascade lower. Conversely, if the market breaks above the 70.15.55 short call, the ceiling has effectively disappeared. The hedging pressure that was selling into the rally is gone, which can allow for a very sharp acceleration to the upside.
Ultimately, the takeaway is this. By understanding these mechanics, you can start to move away from simply following price action blindly. You can start to observe the underlying liquidity structure of the market itself. And developing that skill can dramatically improve your positioning in a market that is, after all, fundamentally driven by these large institutions.